Hello guys, what is happening and welcome to the live stream. Right now we are looking at Jeremy Grantham, we're looking at Michael Burry and what they are telling us, what they are trying to tell us about the current state of the financial markets, the current state of different asset classes. And these are two people that I think are phenomenal minds in the financial space. And you know, Michael Burry gets a lot of slack. You know, he gets slapped a lot by different news media organizations, but really he is just a phenomenal mind and just has the clarity of seeing things as they are, which is what you need. And it's that 10% mindset that everybody wants. It's that investment mindset that everybody wants. So we can learn a lot from these two people. And Jeremy Grantham, just a massive guy, studied multiple bubbles, been alive for so many different cycles that this guy really has the experience to tell it like it really is and like he's seen with his own experience. So he's another guy really worth listening to. So before we get started here, please like the video. Shout out to my Patreons. Thank you so much. And also just to let you guys know, I posted the trades I'm in right now. Well, not the trades, the stocks I'm in right now on Patreon, and also the watch list of stocks that I'm going to be looking at moving forward. Got some content planned for Patreon, different things such as diversifying your banking and everything like that. Basically, I've had to go to Patreon to do that just because the amount of time that YouTube takes up, and I trade also, and basically I need to manage my time, and I just can't give away everything for free. It's just the way it is, the reality of the way it is. So thank you to all my patrons out there, and let's get into this. So bubble expert Jeremy Grantham predicts a huge decline in stocks, tears into Bitcoin, and slams the Fed in a new interview. Here are the top 10 best quotes. Now, this is great because they've kind of summarized it pretty good here. So Jeremy Grantham rang the alarm on a multi-asset bubble in the US, predicted a brutal decline in stocks, and said he would celebrate Bitcoin's demise, speaking on a recent episode of the We Study Billionaires podcast. So I did actually listen to the full interview, and I highly recommend you go check that out because Jeremy Grantham, as I said, fantastic, phenomenal person. So the veteran investor, market historian, and GMO co-founder also tore into the Federal Reserve, cautioned against betting on commodities, and praised Tesla, but ridiculed its peak valuation during the interview. So here's his top 10 quotes from that interview, the takeaways. So number one, there's nothing as quick and spectacular as a bear market rally. With hindsight, they signify very little, but at the time they frighten the pants off bears, and they give hope that all is over, all is forgotten, and it's back to the races. Grantham suggested the current rebound in stocks could continue into September. So he's basically saying that what we're in right now is a bear market rally, and I'm totally on board with that. It's what I believe as well. So I believe there'll be another leg down in this bear market, but like all bear markets, there has to be these sucker rallies to get people suckered back in. And you know, it's usually the massive institutions that start off these rallies. They basically start buying, which pushes up prices, and it's usually when the sellers are exhausted. And then what happens is their algorithms can take the prices higher and then sucker in more people, start seeing stuff is rising. They think the bottom's in, and they look from a technical perspective, and all these algorithms are programmed to make it look like a bottom is in. So they go in, they start buying. All other algorithms come in there and start buying. and it goes up and up and up, and it's based on practically nothing. I mean, the reality of what's happened here is everything has got a lot worse. Like, if you look at the earnings that we've had have just been terrible by a lot of companies, and the economic data that we've had during this rally has been absolutely terrible as well. Yet it's just a classical bear market rally where it makes no actual sense. It means nothing, like Jeremy Grantham is saying right here, but it's going to sucker a lot of people in. And the reason the banks do this, and the reason the big institutions design these rallies, and they are really the ones that make these markets with hundreds of billions of dollars, and it's just insane the amount of money that you need to move a market. Only a financial institution can do it, and that's the reality. So they make these markets sucker people in, also that they can sell onto them. That's the reality of it. Whether you like it or don't like it, that is the reality of it. And to be totally honest with you, it is a lot of hedge fund managers and other people that get caught into these rallies because they have to be invested for their clients, and then they think, oh no, I could be missing the bottom here, and they get FOMO because, as I've said, guys, everybody seems to suffer from these emotional pitfalls. And the thing is, we all suffer from these emotional pitfalls when it comes to investing, but you just have to acknowledge that they're there, understand, and be very cognizant of your decisions when you're putting money to work. And really, that doing so, explaining to yourself, whether it's writing it down in a journal, whatever it is, whether it's talking to somebody else, whatever it is, you just need to get it out there and make sure it actually makes logical sense and makes sense from a perspective of critical thinking, versus just saying, oh my God, Tesla's going up again. I think it's going back to $1,400, so I better buy. And that's the main problem with most investors right now. And, you know, I think the passive investment bubble is just a nightmare. When I was looking into, when you look at what these indexes now, like SPY, are made up of, the S&P 500, you got stocks in there that, like Tesla, that are just hyper overvalued, and they're like some of the biggest weightings in that index. So passive investing isn't safe anymore. I don't think it's particularly safe. That's not financial advice. It's not something I personally participate in, but, you know, some people would. So Michael Burry has also come out this year or last year, and he said the same thing as I've just said, that passive investing is in this massive bubble. And everybody likes to passive invest because essentially they just set it and forget it. They don't have to manage their money, and that means that they avoid the pain. Because typically a passive investor, when markets are going down like they are right now, they don't go in and look at their portfolio and see what's happening. Of course they don't. They're not actively buying. They only buy when markets are rising. The reality is, you want to be the opposite of what everybody else is doing. Go ask your friends, see, are you buying right now? Are you buying right now? And if they're like, yeah, I'm buying or I'm selling, if they're all selling, you should be buying, and vice versa. Retail sentiment, do the opposite of that and you'll make money. That's just the reality of how simple trading is. But it's all about psychology, and it is nothing about technical indicators and all that kind of stuff. It's just really, that is all based on past movements, in my opinion, anyways. So anyway, I got really off track with that rant, but let's continue here. So number 2, in terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, the S&P would have declined by 50% from the peak in real terms. So he's talking in real terms there, remember that. So depending on where inflation is, that's not going to be a nominal decline of 50%, but a decline of 50% nevertheless is a 50% decline. That's a lot. That's a huge decline. So, you know, buying at these just ridiculous valuations is just absolutely just insane. It doesn't make any sense. And it looks right now that the market's on pause. It's going to be very interesting to see. It kind of looks like it's starting to break down already. So we'll see how that materializes. But I'm predicting in the fall it's not going to hold up too well, and it's probably going to come down. And that's just really looking at seasonality of how the markets generally perform, and the fact that the real test will come in September, October, and the market is just fundamentally out to lunch right now. So it's going to be tested against that. So another thing, number 3, I don't include the classic FANGs as being in the super speculator category. I think you could throw Tesla in at its peak. That was super speculative, great company, but a bit of a silly price there. Elon Musk's electric vehicle company commanded a market capitalization north of 1.2 trillion in January. Yeah, he's exactly right, and my thoughts on Tesla are the same. Like, I think Tesla, I mean, I wouldn't say it's a fantastic company. Like, I know a lot of people who have Teslas, and they say nothing nice about Tesla's service, the reliability of Tesla, you know, their software glitches and malfunction, their customer service. Everything is just garbage that comes out of Tesla. Yeah, you know what? Most people invested in Tesla probably don't even own one. So what can you say? There's a bunch of people that probably do, and are just diehard Tesla fans. But, you know, it is selling a lot of electric vehicles, but it's just getting more and more of a crowded space. And I'll be totally honest with you, I would buy a BMW 5 Series electric vehicle over a Tesla any day of the week. I've sat in both, and the quality of the BMW versus the Tesla is just ridiculous, and the BMW is rivaling on the same price for the electric one that's coming, and it is just, it blows the Tesla away. And you know, the environmental aspects, as we know, are just a facade. Like, there's no environmental benefits to buying an electric vehicle. There's also no benefits to your mobility. In fact, you make it worse, because now you got to charge up for hours. But anyway, I'm getting real off topic there, so let's slow that one down. It's hard in a bull market to get your brain around what happens in a bear market. Amazon in the 2000 burst came down 92% with rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. So yeah, he's exactly right there. That during these demises, you know, you can have things that are hidden gems there that you want to own, and are just at a spectacular discount. And that is really what you have to try and look for, those diamonds in the rough. Tricky to find, and you can only allocate small amounts, because if they're considered high risk, then that's what I do personally. But you know, it is true that there is a lot of diamonds that you can find in the rough in these sort of markets. But right now, as it stands, I feel like there's a lot more downside that has to come. So he goes on here to talk about Bitcoin. I mean, before I even say what he's saying about Bitcoin here, I just want to offer a disclaimer. You know, Bitcoin is incredibly emotional. Every time I've mentioned it on this channel, I get some person in the comments blowing up over the fact that I mentioned Bitcoin and you don't understand it, everything else like that. And, you know, all I would say to them is, if you're that emotional about it, you should not be invested in it, because you are just not you're never going to be able to sell, because I can tell by your comment and the way people have said stuff like that, you know, and you should be able to tell too that you are way too emotionally involved in that, and you shouldn't be into it, because how are you going to sell? Like, just because something's fundamental value in your mind is there, does not mean it won't go down 90% in value. It does not mean it isn't manipulated like everything else. And Bitcoin, you know, is the king of things that is manipulated, because it doesn't trade on anything. It trades on the NASDAQ, which is effectively the most speculative index out there. So you can throw it in the bag with that. So the fact really is that Bitcoin is incredibly speculative right now. And, arguably most people are buying it because they feel like it's going to be some get rich quick scheme. Unfortunately, that's the reality. Until that all bleeds out or changes and the volatility dies down and you can tell, which I don't think it will ever allowed to be. I don't think it will ever be allowed to happen because the banks want this to be massively manipulated, so it is not seen as a safe investment because it goes outside of the banking system that they control. So remember, Bitcoin is bought with dollars, and dollars are manipulated by the banks mostly within the economy. So think about that. I'm not saying that Bitcoin doesn't make sense or anything like that, or might not go to $100,000 or might not go to $10,000. That's not what I'm trying to say. I'm just saying the manipulation of Bitcoin is really to get people to shy away from that as a safe asset. And I just do not see that I just don't see that dying down at any point in the future. In fact, it could get a lot worse. So just bear in mind, and that's just me thinking logically of how the banks would try and manipulate an asset like that because they don't want people rushing into that type of thing. So here we go. Anyway, Bitcoin is not a good reserve of value as we've seen. It's terrible for a currency exchange. It's expensive to transact, but worst of all, it is deadly to the environment. It's incredibly energy intensive to give you a speculative instrument to wager on. That's it. The fact that it takes our precious energy and has a carbon footprint is the worst crime of all. And the sooner it goes away, the better. So Grantham, obviously, not a big crypto bull there, as you can tell. But what he says there, Bitcoin is not a good reserve of value, as we've seen. It's like I said, think about why that is. Think about why that happens. And just think, is that likely to change in the future? I don't think so, unfortunately. So 6, as a speculative instrument, it's made a lot of money for a couple of hundred people who got in early with a lot. Most of the other people playing it have now lost money. We know that it's the same old, where the rich get richer and the poor get poorer. So any attempt to spin this as an equalizer is just that. It's pure spin. Also on Bitcoin, that's what he was saying there. So it's really interesting, his take on that. And I would think about that because what he said there is very true, and it's true of any asset class, to be perfectly honest. Most people lose money in the end, even though they make so much. Just think about real estate, for example. Let's use Canada as an example and the real estate bubble in Canada. So you got people who levered to buy investment property after investment property after investment property. So those people, they might be making a lot of money. Their net worth might be really big. And then guess what? Banking crisis happens, they lose everything. But at the time, for a long period of time, they were making money, or at least they felt like they had a lot of wealth. But the reality is, those people just don't know when to sell, and they cannot detach their emotions away from what they actually own. So they tend to buy when it is not a good time to buy, and it's a terrible time to buy, and everything like that. And you've seen that with the Airbnb growth and everything that we've seen. So it's really insane. Oh my God, it's 19 minutes. We haven't even got to Burry. I got to hurry up here. So 7, it is dangerous to get involved in a bubble that has more than one asset class: bonds, housing, stocks, and commodities. They give you much greater pressure on recessionary forces, and we are playing with fire this time. Grantham noted that Japan faced a multi-asset bubble in 1989, and its equity and housing markets still haven't recovered. And that will likely be the case for a lot of places in the world right now, Canada included. I think there'll be another case like Japan, because now this can of worms has been opened. Now you've got nations trying to create their own reserve currency, and that's not going to be a fast transition by any means. But having said that, it's going to happen over the next decade or two. And really, are you just going to see the same that we've seen in the past? And that's really where my interest rate video comes into play, which I'll have out for you guys this Sunday. So make sure to look out for that 3 p.m. Mountain Daylight Time. That'll be 5 p.m. Eastern Time, and it'll be 2 p.m. Pacific and 4 p.m. Central on Sunday. So make sure you're on board for that. So yeah, I think it's crazy. So I expect the Fed to be behind the curve. Well, that's no surprise because they already are. To be deep into optimism. It doesn't really have a clue about market bubbles and the damage they do when they break. If I'd been asked to bet, would the Fed get inflation wrong when inflation came along? At any time, I would have said, of course they'll miss it. They'll be late. Their responses will be pretty ill-judged. The Fed's record is terrible. He's exactly right there with the regards to the Fed. They'll always be behind the curve. And that includes when they should be loosening. And they're not. And they're completely behind it right now, as we see, like in effect, whether people like it or not, and how you agree with it from a macro level. But if their monetary policy is based on helping the economy by loosening and tightening, then if you just base it just on that, then they should be loosening right now and they're tightening right now. Because again, they are far behind the curve, like Grantham is saying right now. The world is much better off with moderately high interest rates. Totally agree with that. You get money on your savings. People don't speculate as much. They don't leverage as much. The risk in the system declines. You can afford to buy a house at lower prices, and you can afford to buy stocks and build a portfolio. Yeah, you haven't got these constant bubbles, these massive bubbles that we have. The super bubble, as Jeremy Grantham calls it himself. So, he's totally right there. And it also encourages people to create businesses that produce something rather than businesses that just feed off these assets and are just not really doing anything to help the economy. Yeah, they're contributing to GDP. Yeah, they're employing people, but they don't actually produce anything. They just suck out of the economy, and that's what literally creates inflation. If you've got not a lot of people producing and you've got loads of people taking, then guess what? You're going to have higher prices as a result of that, put very simply. So his last point here is value managers have always hated commodities. They're about as unpredictable as anything on the planet. If you go short, you die 1,000 deaths. And if you go long, it's pretty much as bad. I certainly don't recommend people to go short metals. If you can go in long and throw the key away, I think that will do just fine. It does take nerves of steel, and you better have a good look at your nerves before you do it. So I think he's really talking about precious metals in that rather than most commodities. So really that's interesting what he's saying there. And you can see that from like the mining stocks have just been obliterated over the past sort of year or so. They've continued to go down, but it's all based off of why you hold something. Like, why did you buy that in the first place? Like, did you buy that because you just wanted to see it constantly go up in value? Well, if you did that, then that's a pretty dumb reason to go out and buy like precious metals, mining stocks or anything like that. However, I've always said people need gold. People need to buy gold. It's an insurance policy. Very little people own gold. Once you own it, I recommend you don't keep it at your house, especially considering the times we're in right now. Go put it in a storage unit like I do, or go bury it somewhere if that's your thing or whatever it is. Just remember where you bury it. I could never bury it. Like, I would think that is just, what happens if somebody hops over your fence and just finds out that you bury gold all over your garden? Can you imagine? But yeah, you got to keep it safe. But gold is, it's a must-have. It's an insurance policy on money. It's no form of speculation. It's not an investment product, in my opinion. So therefore, this isn't investment advice. That's just my 2 cents. You know, gold and silver, they've been money for thousands of years. They're not about to stop being money right now. Let's be totally honest about that. They are money, and I believe in them wholeheartedly. So let's go over to Michael Burry and see what this guy is doing. The Big Short's Michael Burry. Big Short investor Michael Burry sold all but one of his stocks last quarter after warning an epic market crash is coming. Okay. Michael Burry, the investor of the Big Short fame, slashed his US stock portfolio to a single holding in the second quarter, a SEC commission filing showed on Monday. This was a couple of weeks ago. Burry's Scion Asset Management disclosed just over 500,000 shares of Geo Group worth 3.3 million. Geo invests in private prisons and mental health facilities and commands a market capitalization of less than 900 million. Now, what's interesting in that is a very small position for Burry. So is he trying to tell us something? And that's what I've been trying to work out. Like, is he trying to say something like he thinks that civil unrest is going to continually rise and more people are going to be incarcerated? Therefore, he's holding this. I'm not sure that this is a play for any type of, you know, it's like it's a speculative play or anything like this. It seems like Burry is just actually trying to tell us something here. Close followers of Burry are likely to interpret his decision to effectively liquidate his portfolio as a bad omen. The hedge fund manager diagnosed the greatest speculative bubble of all time in all things last summer and said owners of meme stocks and cryptocurrencies were careening towards the mother of all crashes. And you know what? Look at what has happened on those meme stocks. Again, they started to go up with the sucker rally and the rug pull has come. And you've got AMC like hitting 52-week lows. Like the thing literally tanked and the rug was pulled yesterday or the day before. So, you know, just so much risk in these things. And, you know, if you look at the Reddit boards, you can get a real gauge of what people think and retail sentiment if you just go to like the stocks Reddit board, any of these Reddit boards, right? Because they'll just all be like, it looks like it's over. And then the market consequently turns off that. It's almost like the algos are just fishing everywhere. But anyway, more recently, he has told investors not to get too excited about the recent rally in stocks, as previous downturns have seen many temporary rebounds before finding a bottom. He also said the silliness in markets during the height of the pandemic had returned and tweeted over the weekend that he can't shake that silly pre-Enron, pre-9/11, pre-WorldCom feeling, referring to the euphoria that preceded the dot-com crash. Scion's portfolio comprised of 11 stocks worth $165 million at the end of March, excluding bearish put options it held against 206,000 shares of Apple. The Scion chief has taken a knife to his portfolio in the past. He pared it from 20 holdings to 6 in the third quarter of last year, reducing its value from $140 million to $42 million in the space of 3 months. Burry rose to fame after his billion-dollar wager against the mid-2000 housing bubble was chronicled in the book and movie The Big Short. He's also known for betting against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund last year for investing in GameStop before it came a meme stock. So this is just so really the thing, the big takeaway from all this is the fact that if you look at the situation as we have it right now, you've got Burry and Grantham essentially saying the same thing, that this is nothing more than a bear market sucker rally. And they're also saying that we're still in this bubble. We've still got these ridiculous valuations, and you've still got some of that pent up euphoria that is left over. It doesn't just diminish straight away as soon as the markets start going down. So I think the key thing to really take away from this is just caution ahead, because there is a lot of moving parts, and these two guys are incredible minds. Always when I hear them speak, I am looking and listening, and you know, it's nevertheless the case in this case too. And that's why I wanted to bring it to you guys, and I can't thank you enough for being on this live stream today. So if you did enjoy this live stream, then please make sure to hit that like button. It greatly helps. And if you enjoy this kind of content and you're not already subscribed, then consider subscribing below. And I will see you guys on the next video. Take care. Peace.